Well guys, over the past month or so, I have been moving more and more into cash and cash equivalents and putting less and less money into stocks. And I want to explain into detail in this video exactly why I'm doing this. I'm going to show you some ratios today. We're going to show you some ratios that might kind of open up your mind on maybe it makes sense to go a little more cash heavy right now. Or we're going to also talk about, for some of you newer investors, if it is actually smart to go more and more cash heavy right now, or if you should be investing in the market. So we're going to talk about all that, put everything else to the side for the next 10 minutes, and definitely watch this video all the way through. I think this is going to be a very, very important video. And when I'm saying, someone like myself that's a stock market investor is going more and more into cash, I think that's usually, a sign that, maybe we should kind of see what's going on here, okay? So as you guys know, if you've ever taken like any of my premium products, like my Becoming Master of Stock Market course, or like been in my private stock market group or something like that, I always talk about 10 to 30% of cash. This is something I've been doing for the last several years, and I love this. I absolutely love being 10 to 30% of my wealth in cash and cash equivalents. Doesn't mean actually physical cash. Could be money in savings accounts, checking accounts, those sorts of things. That's also cash. Money you can get to in a very easy manner to deploy into the market whenever you want, okay? It gets down to about 10% if I'm buying super heavy. So last November and December of 2018, I was buying into the market super heavy, and I got really, really low on cash, okay? And if we're talking about a time like right now, I'm getting close to having 30% of my wealth right now in cash and cash equivalents as of right now, okay? So I'm starting to get up to this number, and there's a chance I might even exceed that number just a bit. But I absolutely love being always 10 to 30% of cash. 10% when there's a ton of deals and you're buying stocks like crazy, 30% when there's not as many deals, and that's what we're getting up to right now, okay? 3 reasons why I love this. One is it keeps you disciplined. Always think about yourself in a situation. Don't worry, we're going to go through all the charts and whatnot. I'm going to show you all the data behind this in just a minute. But as far as staying disciplined, think about yourself as a company, right? Would you ever invest in a company that had no cash on their balance sheet, had no investments on their balance sheet? No, you wouldn't. You would look at that and they'd be like, dude, they're one problem away from being an insolvent company and having to sell off assets and being in a real bad situation, right? So look at your own life. Why would you ever want to be in a situation where you have every dime invested in the market and you don't have any cash laying around, you don't have any money laying around? You wouldn't. You would look at that as that's a very undisciplined company, and you should look at that same way with you. And back in the day, I used to be all in the market. Every dollar I had was in the market all the time. And I look back on that time and I'm like, that was a very undisciplined move. You got to stay disciplined, okay? Number 2, it allows you to take huge advantage of opportunities. The stocks drop all the time, right? The market drops all the time. Sometimes you have these 10% plus corrections in the stock market, which we'll likely have at some point, either maybe over the next month or 2 or in 2020 at some point. We'll likely have a 10% plus correction in the stock market. And when that happens, it allows you to take huge advantage of loading up on stocks and taking advantage of those deals. If you have no money laying around all the time, you have no cash, you can't take advantage of the good deals the market presents itself. There's always stocks report some earnings and you already like that stock, and then it goes down a ton. You get to buy for a way cheaper price, or the market in general goes down. If you don't have any cash and cash equivalents laying around, you can't ever take advantage of these deals. And there's some extraordinary opportunities that always present themselves in the stock market, and we'll probably get one of those opportunities in 2020 at some point, and you want to be in a position where you can take advantage of it. And number 3, it just allows for less stress. Think about it. If you're all in the market constantly and you don't have any money on the sideline, it just leads you to have more stress, because you're like, oh my gosh, what if the stock market crashes? What if the stock market goes down a bunch? What if this happens? What if I have an expense here and there? If you always got a lot of cash laying around, cash and cash equivalents, it allows for a much less stress in your life, okay? And so when I'm talking about, being more and more cash heavy, I'm talking about putting income related things toward cash and cash equivalents. So if you have a job or you have a business, just sticking more and more money into basically cash and cash equivalents rather than taking that income and deploying it right into stocks, okay? So that's why I always like to stay 10 to 30%. I've switched this a few years ago and I love it, and I cannot say enough good things about being 10 to 30% of your wealth always in cash and cash equivalents, okay? So let's start going through some data here. And as we go throughout this data, you're going to see it kind of does make sense that I'm going more and more into cash right now, okay? okay? So first thing we're looking at here is the S&P 500. And as far as the S&P 500, I want to see like what is the 1 year return for the S&P 500. And the 1 year return, always very important to look at for the S&P 500, is it's up over 15% in the past 1 year. S&P 500 on average, you can expect every 1 year for the S&P 500 to usually go up like 7 to 8%. When we talk about a 15% number, we're basically talking about a double up on how the S&P 500 usually does, okay? About a double up of how the S&P 500 usually does on a 1 year time frame, okay? So just looking at that data right there alone, it should tell you, whoa, the market's been in a very good place, needless to say, over the past 1 year. Like, you should hopefully be green on your accounts of some kind. And if you've been investing for over a year and you're not green, then you definitely, are in some bad stocks, needless to say, because you should be green if you've invested money over the past year. Like a 15% plus gain in the S&P 500 is amazing, okay? That's reason number one. Next one, let's look at the NASDAQ performance over the past year. The NASDAQ performance over the past 1 year, the NASDAQ's up over 18% in the past year, okay? Up over 18%. That's unbelievable performance. Once again, I think it's really important to pay attention to the 1 year, not necessarily year to date. Because if you look at the year to date, it's even up a lot more than that. Year to date's up over 25%. Why is the year to date up so much? Because the stock market went down so low in November and December, and then it started to finally climb out in like January. So I think the 1 year is more important. But 18% plus gain in the last 12 months in the NASDAQ is a big, big move. And that's about a double up compared to like what you should expect from the NASDAQ, okay? So right there alone, we can see the stock market is, generally speaking, it's going to be, probably higher priced. Stocks are not going to be as good at deals. And I'm in the business of buying stocks that are good deals and especially buying heavy when I see great deals. And right now in the stock market, I see very few good deals and I see almost non-existent great deals as of right now in the stock market. And I'm in the business of buying great deals and also buying good deals, but just buying good deals less heavy than great deals. And if I'm not seeing those type of opportunities, then, it just makes sense to go more and more into cash. Here we're going to look at the S&P 500 PE ratio by year. So as of right now, we're at about a 22.6, somewhere around there roughly. Like just say, between a 22 and a 23 PE right now. There's only been a couple years where it's been that high in the past, number of years. And if you look here, 2017, 2018, we were up at some big numbers there. But keep in mind, 2017, 2018, that was around the time when the U.S. government moved U.S. corporations from being at a tax rate of 35% to 21%. So needless to say, corporations got a massive, massive tax cut during that time. So it kind of made sense that the market at that particular time was a little higher valued because they were pricing in the fact that, basically corporate tax rates were going to drop substantially. When you talk about, the government gets 35% of the pie to now they get 21%, that's a massive, massive difference. And it's going to make all corporations, basically their profits look like they're way better year over year. So it made sense. But once again, it's not like we've had any time recently where it's really been that high. I mean, you go back to 2014, we were at about an 18, 2013, 17, 2012, we're at a 14, 2011, we're at a 16. And so needless to say, we're a little high on the PE ratio as of right now because there's no magic pill that's going to suddenly come that is like, a corporate tax cut from 35% to 21%, okay? This next one, this basically shows you a chart of it, okay? And what you're going to find, this shows you, 100 plus years here. You're going to find that if the PE ratio on the S&P 500 is under 20, generally that's a time when it's like, I call it shooting fish in a barrel. You just get great opportunities. There's a ton of stocks that are great deals. Almost every stock's at least a good deal, and most stocks are great deals when you're looking at S&P 500 PE ratio under 20. And you just see throughout history, like that's usually great times to buy stocks. Now, I also drew in a green line there, okay? And basically the green line is right around around 25. And if the S&P 500 P ratios get over 25, that generally means the stock market is overvalued, okay? So most of the time you should expect the S&P 500 to trade somewhere between like a 20 and 25, especially with where interest rates are nowadays. That's about a fair value. It gets over 25 and you really start getting into overvalued territory. And when you're talking about a 22 and a half or so, we're getting close to there. We're not there, but it's getting closer and closer. Now, you can look back at the tech bubble time and look at how high it got back then. It was way over 30 for several years. And at one point, it rose to over 40 during the tech bubble. So we're certainly not in a situation like that. But at the same time, we're certainly not in an undervalued situation. And as me being in the business of buying great deals, you're just not going to find that many great deals in the stock market right now. And if that's not enough like proof in the pudding, let's go ahead. I'm going to take you through my public account that's available in my private stock group that everybody can see every move in this account. And tell me what stock in this account, is like a great deal right now, okay? As we look at this account, let's go through the positions. Do I really want to buy Cirrus Logic up 45% right now? It's up 45% since I built my stake, and that's where my cost base is at. Do I really want? No, not really. That's not a great deal, okay? ELF on a shelf's up almost 138%. Do I have to run out and buy some ELF right now? No. If anything, I'm going to probably sell off my remaining shares there if the stock continues to climb out. I definitely don't want to buy any of that. Facebook, I could make an argument that the risk reward is still in my advantage. And even though we're up 23+% on Facebook, I could make an argument that it's like, okay, I could buy some more Facebook stock. Fizzy Get Dizzy up 21%. Do I want to buy some more Fizz? No, I don't. iRobot, that's the easy one in the account. And I'm like, yeah, that makes sense for me to buy some more iRobot because that's the only one we're down at all. And especially that's the only one we're down double digits on, okay? So iRobot, that's the one stock in this account that I'm like, yes, it makes sense for me to, add more shares and continue to buy iRobot. Nordstrom, do I want to buy more Nordstrom stock up 20+% in such a short amount of time we've been in that stock? No. Skyworks Solutions, huge 5G opportunity there. And I love Skyworks Solutions, but do I have to go run out and buy some Skyworks Solutions tomorrow? Up 21+% on that position. That doesn't even account for the dividends they've paid us out. No, I really don't, okay? Tapestry Company up nearly 30% in a matter of a few months. We've held that stock. Do I have to go buy some Tapestry tomorrow? No. Tesla's up 44%. And if everything works out great for me with Tesla long term, even shares here would be a steal. But at the same time, this was a stock that was trading in the low 220s just a few months ago, okay? Just a few months ago. And, it's climbed $100 a share roughly in like a snap of a fingers, okay? Do I have to run and buy some Tesla tomorrow? I don't. Ubity Booba's up almost 10%. Wynn's up 10+%. And so if we're just looking at that there, what makes me say I've got to go buy any of those stocks here tomorrow? There's really no reason other than maybe iRobot that I'm like, I've got to go buy that stock tomorrow. So this is why I'm going more and more cash heavy. The market in general is just not presenting a lot of great deals, and I love to buy great deals. The market in general is not even presenting that many good deals right now. In good deals, I slightly buy good deals, I buy heavy great deals. And so if there's like almost no great deals and there are very few good deals, then why am I going to continue to buy stocks? I'm just going to continue to go more and more cash heavy because as we know, the stock market doesn't go up in a straight line. Something will happen and then we get a big correction, or some stocks I love that will end up dropping big, they missed an earnings, something happens, and then I can deploy out some of that cash. But if I'm looking at things right now, it just doesn't make sense for me to say, I've got to go load up on stocks right now. Now, let's talk about you, okay? Let's talk about if you're in a situation, you're watching this video right now, and you've just started investing in the last 1 year, okay? Most of you guys will likely have a smaller amount of money. Maybe you're investing your first $1,000 or your first $10,000 or something like that. The most important thing for you guys is to get experience in the market. Get experience looking at stocks, researching stocks, owning stocks, getting used to the volatility of these stocks, going up big, going down big, and all those sorts of things. Your most important thing right now is trying to build wealth in the stock market and getting that experience right now. Whereas versus someone like myself that has the majority of my wealth, a considerable amount, in the stock market. The majority of my wealth is tied up in the stock market already. And I have 10 plus years of experience in the stock market. So getting experience for me isn't important. And I already have a ridiculous amount of money in the stock market. That account I showed you right there is one of 7 stock market accounts I have, okay? One of 7. So needless to say, I have, an unbelievable amount of money invested in the stock market. So if I want to pull back a bit and I say, I don't want to buy as heavy, it definitely makes sense. But if you're a new person in the stock market, you've got to get experience. You can't get experience by just sitting on the sideline, never playing the game. You have to get in the game. So for you guys, you just have to keep learning. You have to get in good habits. You have to research companies. You have to be looking for the great deals. And by the way, things can change very quickly. Things can change very, very quickly in this game, okay? We could have a situation that over the course of the next month, the stock market tanks, the stock market gets scared, volatility creeps up, and all of a sudden, I'm starting to deploy money in the stock market left and right. Like that's the stock market for you. Just because I'm going cash heavy right now doesn't mean I'll be cash heavy a month from now, 3 months from now, or 6 months from now, because it happens that fast. It happens that fast. And if you're not ready for it, and you don't have some cash ready for it, and you don't know what to look for in these stocks, then you just miss out on some unbelievable opportunities, okay? I'm gonna leave this video off with an Instagram post that I posted on December 7, 2018. Enjoy that post and have a great day.